There's a rule that gets repeated in almost every retirement planning video, every financial advisor office, every tax prep article you've ever read. Only convert to a Roth IRA if your future tax rate will be higher than your current one. Sounds logical, clean, mathematical. And if you've been following that rule, I understand why. It made sense when you first heard it. But that rule has two holes in it that nobody talks about. First, it assumes you will spend every dollar in that IRA before you die. If you won't, you're not just making a tax decision for yourself. You're making one for your kids in a tax environment they have no control over. Second, it treats a Roth conversion like a decision you make on a spreadsheet with stable numbers that sit still. But your IRA doesn't hold cash. It holds stocks, and stocks move. Converting at the wrong moment in a bull market means you could be paying taxes on values that evaporate 2 months later. Starting in 2026, the Tax Cuts and Jobs Act provisions have expired. Rates have stepped back up. People who converted at the wrong time or funded that conversion from the wrong account are looking at tax bills they did not need to pay. Before you move any money this year, there are two numbers you need to see clearly, your real break-even point, and which account you use to pay that tax bill. Because it turns out, those two details alone can determine whether a Roth conversion builds your wealth or quietly drains it. Most people who decide to do a Roth conversion get the big decision right. They run the numbers, they pick a reasonable amount, they time it to stay inside a bracket they can live with. Then they click the wrong button. On almost every brokerage platform, when you initiate a conversion, there's an option that looks something like this. Withhold taxes from this conversion. It's right there, easy, convenient. The system will handle it for you. I've watched people check that box without a second thought. Smart people. People who spent months planning this move. What they don't realize is that withholding taxes from the conversion itself means the money to pay the IRS is coming directly out of the IRA. And once money leaves a tax-advantaged account to pay a tax bill, it never goes back in. It can't compound. It can't grow tax-free. It's just gone. That's what's called tax drag. And it's the silent killer of Roth conversions, done right on paper, but wrong in execution. Here's the concrete difference. Say you're converting $50,000 in 2026. At a 28% effective rate on that amount, you're looking at roughly $14,000 in taxes owed. Option 1, you let the platform withhold that $14,000 from the IRA itself. You convert $50,000 on paper, but only $36,000 actually lands in the Roth. That $14,000 never gets to grow tax-free. Option 2, you pay that $14,000 from a money market fund or a taxable brokerage account sitting outside the IRA. The full $50,000 moves into the Roth. All of it compounds from that point forward, shielded from taxes permanently. Vanguard's own break-even tax rate framework shows that when you pay conversion taxes from outside the IRA, the math almost always favors converting, even if your future rate is roughly the same as your current one. When you pay from inside the IRA, the math gets a lot harder to justify. I'll be honest about something. About a decade ago, I thought the same thing most people think. Money is money. It doesn't matter which pocket it comes from. I let one of my own conversions get handled automatically, taxes withheld right from the account. When I looked at the projection a few years later, that one lazy decision cost me more than I want to admit. The convenience wasn't worth it. The rule is simple. Even if the execution takes planning, conversion dollars go into the Roth, tax dollars come from somewhere else. Outside money funds the tax bill. Inside money stays inside and grows. Now, even if you get that part exactly right, there are two IRS mechanisms that can quietly ambush you anyway. One can add thousands of dollars to your Medicare bill with a $1 mistake. The other can make you pay income tax on the same money twice, and the IRS won't remind you that you're doing it. Let's talk about two traps that don't show up in most Roth conversion calculators. They're not hidden exactly. They're just buried in the kind of IRS language that makes most people's eyes glaze over and move on. The first one is IRMAA. Most people understand how tax brackets work. You cross into a higher bracket, and only the dollars above that line get taxed at the higher rate. Cross by $1, pay a little more on that $1. The damage is contained. IRMAA doesn't work that way. IRMAA stands for Income-Related Monthly Adjustment Amount. It's the mechanism Medicare uses to charge higher earners more for Part B and Part D coverage. And unlike a tax bracket, it operates as a cliff. In 2026, if you and your spouse file jointly and your modified adjusted gross income stays below a certain threshold, you pay the standard Medicare premium. Cross that line by a single dollar and your premium jumps, not gradually, all at once. We're talking hundreds of dollars per month, per person, for the entire following year. The number that trips people up is around $218,000 for married couples filing jointly, based on current SSA guidelines. A Roth conversion done without accounting for that threshold can push your income over the edge without you realizing it until the Medicare bill arrives. This is why the conversion amount matters as much as the conversion itself. You're not just managing income tax brackets. You're watching a second set of lines that the tax software doesn't always flag clearly. The second trap is quieter and in some ways more frustrating. If you made non-deductible contributions to a traditional IRA at any point, those dollars went in after tax. You already paid income tax on them. When you eventually convert that IRA to Roth, those after-tax dollars should not be taxed again. But the IRS doesn't track that for you. To protect yourself, you have to file Form 8606. Every year you made a non-deductible contribution. That form is how you establish your basis, the portion of your IRA that has already been taxed, so the IRS knows not to tax it again when you convert. If you didn't file it, or if those returns are buried in a filing cabinet from 15 years ago, and nobody remembers they exist, you are at risk of paying income tax twice on the same dollars. The IRS won't volunteer that information. They'll just collect. I'll tell you the truth. The first time I sat down with Form 8606, I spent an entire Sunday afternoon on it, 3 cups of coffee, and I still ended up calling a friend who's a CPA because I genuinely could not figure out what the instructions were asking. I don't say that to be funny. I say it because if you've looked at that form and felt confused and a little embarrassed about it, that reaction is completely normal. The form is not designed for clarity. If you've made non-deductible IRA contributions at any point in your working life, the most important thing you can do right now is pull your old returns and find out whether Form 8606 was filed. If it wasn't, a tax professional can often reconstruct that basis. It takes work, but it's recoverable. What isn't recoverable is double paying taxes for the next decade because no one caught it. If any of this is starting to sound familiar, or if you're realizing there are years of returns you haven't looked at in a while, you're not alone in that. Hit the like button so I know this is landing, and subscribe if you want me to keep breaking down the parts of the tax code that actually affect people in your situation. We've been focused on your individual tax picture so far, but there's a much bigger problem that most Roth conversion advice completely ignores. It's not about your tax rate. It's about what happens to this money when it eventually passes to your kids. and why the rules have changed in a way that turns a well-meaning inheritance into a tax emergency. Here's the assumption buried inside almost every Roth conversion argument you've ever heard. It assumes you will spend the money, that you will draw down that traditional IRA steadily through retirement, that the account will be mostly empty by the time you're gone, and that the only tax question worth solving is yours. For a lot of people reading the headlines about Roth conversions, that assumption is wrong. If you've spent 30 or 40 years as a careful saver, if you lived below your means, maxed your contributions, let compound growth do its work, there's a real chance your IRA will still be substantial when you pass it on. And that's when a decision you made at 62 becomes your child's problem at 45. Consider someone like Mark, 62 years old, disciplined saver his whole career. Traditional IRA worth about $2,500,000. Mark runs the numbers and decides he doesn't want to convert to Roth. The tax hit feels too big. He's in a 28% bracket now, and he figures his rate in retirement will be lower once he stops working. The math on paper seems to support waiting. 15 years later, Mark passes away. His daughter is 47. She's a senior director at her company, earning well into six figures. She inherits the IRA. Under the SECURE Act rules that are currently in effect, she cannot stretch distributions over her lifetime the way beneficiaries once could. She has 10 years to drain the entire account, not gradually over decades, 10 years. So every year for 10 years, she's forced to pull a large distribution out of that inherited IRA. Those distributions stack directly on top of her existing salary. And in the tax environment we're living in now, with the TCJA provisions expired and the top federal rate back at 39.6%, she's watching close to 40 cents of every dollar Mark carefully saved disappear to taxes. Mark paid 28% to protect it. His daughter is paying nearly 40% to receive it. The family didn't gain anything by waiting. They lost. I sat with a client last year who was in almost exactly this position, except the timing made it even harder. She had just been promoted to a director role, and in the same month she received notice of an inherited traditional IRA from her father. What should have been a moment of financial security became a source of genuine distress. The forced distributions pushed her income high enough that her son lost eligibility for financial aid he had been counting on for college. She said to me, quietly, "I wish my dad had known this was coming." That's the cost that doesn't show up in the simple tax rate comparison. The standard Roth conversion argument is built around one person's lifetime tax rate. It asks, will you pay more later than you're paying now? If yes, convert. If no, wait. But that framing only works if the money ends with you. If there's a meaningful chance your IRA passes to someone else, the relevant tax rate isn't yours. It's theirs, at their income level. In the tax environment of a decade or two from now, which you cannot predict and they cannot control. Converting at 28% today, even if it feels like a significant hit, may be the most generous financial decision you ever make for your family. You absorb a known, manageable tax cost now. In exchange, your heirs receive an account that grows tax-free and can be withdrawn tax-free with no 10-year countdown, forcing them into a higher bracket at the worst possible moment. That's not just tax planning. That's the difference between leaving a gift and leaving a problem. Once you accept that a Roth conversion is partly a decision about your family's financial future, the next question changes completely. It's no longer just whether to convert. It's when. And the answer has less to do with the calendar than most people think. Most Roth conversion advice comes with a built-in calendar assumption. Run your numbers in November. Execute in December. Done. The logic is reasonable on the surface. You know your income for the year by then. You can see exactly how much room you have before hitting the next bracket or the IRMAA threshold. December feels like the right time to make a precise decision. The problem is that December doesn't care what the market is doing. Your traditional IRA isn't holding cash, it's holding positions, stocks, index funds, target date funds. Assets whose value on any given day is driven by market forces that have nothing to do with your retirement plan. So when the S&P 500 is sitting near an all-time high in December and you execute your conversion at that moment, you are paying taxes on peak valuations. If the market drops 15% in February, you've already handed the IRS money calculated against numbers that no longer exist. That value evaporated. The tax bill didn't. Think about it this way. Say you want to convert 1,000 shares of an S&P 500 index fund. In December, at the peak of a bull run, those shares are valued at $150,000. You convert, you owe taxes on $150,000. Now imagine you waited. 2 months later, the market corrects 20%. Those same 1,000 shares are now valued at $120,000. You convert the same position, the same number of shares, but you only owe taxes on $120,000. That's a $30,000 difference in taxable income. At a 28% rate, that's roughly $8,400 you kept instead of sending to Washington. And here's the part that makes this worth understanding clearly. When the market recovers, and historically it does, that recovery happens inside your Roth account. Tax-free, permanently. The person who converted at the peak paid more to move the same asset. The person who converted during the correction paid less, moved the same asset, and captured the full recovery with no tax consequence on the other side. There's a term for this in portfolio strategy. Some advisors call it value-based conversion timing, as opposed to calendar-based conversion. The idea is straightforward. You're not just watching your income and your brackets, you're watching your portfolio value. A market pullback of 15% to 20% is not just a moment of anxiety. For someone planning a Roth conversion, it's a discount window. This isn't market speculation. You're not trying to predict where the S&P 500 goes next quarter. You're not timing the market in the traditional sense. You're simply recognizing that the cost of conversion is directly tied to the current market value of what you're converting, and that cost fluctuates. Executing when that value is temporarily depressed is a mechanical advantage, not a gamble. I've seen people sit in this strategy for 2 or 3 years, waiting for a correction that feels big enough. That's not the point either. A 10% to 15% pullback, the kind that happens with reasonable regularity across any decade of investing, is enough to make a meaningful difference on a large conversion. You don't need a crash. You need patience and a number in mind. The investors who tend to build the most tax-efficient retirement accounts aren't the ones who execute on a fixed schedule. They're the ones who know what they want to do and wait for the market to give them a better price to do it. Stop looking at just the tax calendar. Start looking at your portfolio value alongside it. The remaining question is a practical one. Once you decide to convert, and once you've identified the right moment to act, how do you actually execute it without triggering an IRS underpayment penalty? Because moving this much money in a single year outside of your normal withholding creates a timing problem with the IRS that catches a lot of people off guard. Strategy without execution is just intention. So let's make this concrete. There are 3 things you need to do before you convert a single dollar. Not after, not during, before. Step 1, hunt down every Form 8606 you've ever filed. go back through your tax returns. If you made non-deductible contributions to a traditional IRA at any point in your career, those contributions should have been reported on Form 8606. That form establishes your basis, the after-tax dollars that should not be taxed again when you convert. If those forms are missing, you may be sitting on a legitimate tax reduction you don't know about. A qualified CPA or tax professional can often reconstruct that basis using old records, contribution histories, and prior returns. It takes work, but the math usually justifies it. On a large IRA, an undocumented basis of even $20,000 or $30,000 translates directly into taxes you should not owe. Don't leave that money on the table because the paperwork felt like too much to deal with. Step 2. Build a separate cash reserve specifically for the tax bill. This is the one that most people either skip or underestimate. Before you convert, identify where the tax payment is coming from. It needs to be outside the IRA, a taxable brokerage account, a high-yield savings account, a money market fund. Something that isn't protected retirement money. Figure out the approximate tax owed on the conversion amount, set that cash aside, and treat it as already spent. If you're converting $80,000 and you're in the 24% bracket, you're looking at roughly $19,000 in federal tax. That money needs a home before you click convert, not after. The discipline here protects you from the single most common execution error, letting the platform withhold taxes from the conversion itself and permanently reducing the amount that makes it into the Roth. Step 3. Use the IRS safe harbor rule to avoid underpayment penalties. When you do a large Roth conversion mid-year, you are generating significant taxable income outside of your normal withholding. If you don't plan for this, the IRS can assess a penalty for underpayment, even if you settle the full bill by April. The safe harbor rule gives you a clean way out. If your total tax payments for the year, including withholding and estimated payments, equal at least 100% of what you owed in the prior tax year, the IRS cannot penalize you for underpayment in the current year. For higher earners, above $150,000 in adjusted gross income, that threshold rises to 110% of the prior year's tax liability. Here's the practical piece that most people don't know. If you have an IRA and you take a distribution in December with taxes withheld, the IRS treats that withholding as if it was paid evenly throughout the entire year. That means a single December IRA distribution with a large withholding can retroactively satisfy your quarterly estimated payment requirements for all 4 quarters. This matters if you converted earlier in the year and are now worried about a quarter 1 or quarter 2 underpayment. A properly structured December withholding can cover the gap. Run these numbers with a tax professional before year end, not the week of April 15th. The difference between planned and reactive here can easily be $5,000 to $10,000 in penalties and interest avoided. If this checklist saved you a few hours of reading IRS publications, share this video with someone in a similar position. The people who need this information most are usually the ones who haven't thought to look for it yet. Preparation is what separates someone who controls their tax outcome from someone who just reacts to it every spring. A Roth conversion is not a tax form. It's a decision about what kind of financial life you want to live from this point forward and what you want to leave behind. You spent 30 or 40 years building this. Careful decisions, deferred gratification, contributions made in years when the market scared everyone, and you stayed in anyway. That's not nothing. That's a body of work. And all of it can be quietly eroded, not by bad investments, but by avoidable tax mistakes made in the decade before and after retirement. the wrong source of funds for the tax bill. A missed Form 8606 from 15 years ago. A conversion executed at a market peak because December felt like the logical time. A traditional IRA left unconverted because the tax hit felt too big today, passed on to a child who pays nearly 40 cents on the dollar to receive it under a 10-year forced withdrawal rule. None of those outcomes are inevitable. They're all decisions. And they're all reversible or avoidable with the right information at the right time. What we covered today is a framework, not a formula. Your income, your bracket, your family situation, your portfolio composition, all of it shapes what the right conversion amount and timing looks like for you specifically. But the principles hold across almost every situation in this income range. Pay taxes from outside the IRA. Watch the IRMAA thresholds. Reconstruct your basis. Convert when the market gives you a discount. Protect your heirs from a tax bomb they didn't see coming. You worked 40 years to build something worth protecting. Don't let a mathematical error at 62 define what's left of it. I'm Wes. Thank you for watching Wes Investor. If this gave you one thing to act on, subscribe so you don't miss what's coming next. See you in the next video.